Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how investors are looking to get back to work. Phil, it's great to have you with us as always. Thanks for joining me on Trade Talks. And it's really interesting because with regards to equities, there's a number of concerns that strategists, analysts, and economists need to tackle with the environment that we're in right now. Before we get into that, though, let's take a look at our most current data that we have on COVID-19 as we're starting to see clusters of new infections offset the economies that are opening up.
Yeah, obviously we've seen that Korea got the virus under control pretty quickly, but there was reports on the weekend that they had a cluster of new infections, and you can see that in the Korea chart. It's not a massive spike, but it's a little bump. And you compare that to the US, where we're slowly getting things under control. The last couple of days have been really positive in terms of the drop in new cases. But with this many people still infected, people back to work does raise the chance that we go and double cases pretty quickly. Other countries have seen that happen. Iran's seen it happen. Saudi Arabia has seen it happen as well. And that's coupled with the fact that clearly globally, the new cases are continuing at about the same level day after day after day. And that's because the emerging markets now are starting to see COVID come through their economies. And Russia is actually now number 2 in the world for cases with 232,000, obviously a long way behind the US with 1.35 million. But Russia has not crushed the curve at all yet. And there's a lot of other countries like Brazil with big populations and exponential growth of COVID at the moment.
Yeah, and that's quite concerning because they don't have the healthcare infrastructure like the United States or other developed nations may have. But if you look at it on a relative basis, if you look at this next chart with Spain and you look at the scale of it, I think that's something that needs to be taken into consideration as well.
Yeah, it's difficult to find numbers when everybody's got different populations. So this is an interesting way to kind of compare how he's done in coronavirus. We've said a couple of times that Germany has done a really good job, and you can see that here. Canada's actually done a pretty good job as well in terms of the number of cases per population. So relatively good control of COVID, nothing like China, obviously. You see actually Spain, which got a little bit of press, but not as much press as Italy, is so far the worst country in terms of per head population getting COVID.
And if we move along to our next slide here, we have a couple charts on this page where you're looking at the shape of the recovery. It feels like a V shape in the market, but now economists are starting to think it's a swoosh.
Yeah, I totally agree. The market seems in a V, doesn't it? It seems to be looking at the earnings. We're looking at the forward PE in the market and how expensive the market looks. And that's basically because people are expecting that the forward PE is basically wrong. The E from right now is just for very long. It's going to be replaced with an E that's more like what we used to have. And so the market's going to recover pretty quickly. But when you look at China, which is the blue and red chart, you can see its recovery for the most part, just looking at lots of different data series. This is restaurant sales, but it's consistent across lots of different industries. It wasn't a V-shaped recovery. It was a slower sort of building of confidence and getting people back to normal that they've seen. And they're still not quite back to 100%. Looking at factories, looking at production. And so that shape really is a Nike swoosh, isn't it? Compared to what we've seen in the world, obviously the world is a month or two behind China. We're still in the middle of having restaurants and things completely shut down. But we have seen a slight US in retail sales. We've seen a slight uptick in hours worked. So there's definitely clear signs that people are getting back to work, which is good. The risk is really, do we have that second wave? And that's why we start by watching what's happening in Korea and what's happening around the world for hints at what we might have to deal with.
Yeah, if we get into the real meat of the conversation here, what to worry about in markets, that graph is pretty concerning. There's so many variables that are out there.
Yeah, and this is a survey of independent people. So you can see the second wave is really the big concern with people about what the market valuation should be. But I'm kind of, I guess, happy to see that the top 3 of the things that we've been focusing on day after day is, the geopolitics is driving the market. If there's a shift in trade or the China-US relationships, that's often a bad thing for markets or a good thing if it's a recovery. We've talked a lot about valuation, and that's a concern of people as well. But the most important thing is the second wave. And so right now, each day we've seen very little new information about a really sharp reduction in cases or a spike in cases. I guess because the issue period is a week, it takes a long time, even for the openings that we've seen in Europe, to filter through to new caseloads. And so we're watching that data. We're going to get it in about a week's time. And if Germany and countries like that do see a second wave, it has big implications for how quickly Americans can get back to work, which itself has big implications for how quickly we can get GDP back and sales back and really recover the economy and keep those values they are right now.
Yeah, and to wrap up here, speaking of trying to model out valuations, we haven't even factored in that the Fed hasn't started buying ETFs yet.
Yeah, I know. I remember when this news came out. I mean, it was part of the Fed's huge injections of capital and rescue plans. They said they were going to come out and buy corporate bonds and buy the corporate bond ETFs. And the next couple of weeks, we saw really big inflows into those corporate bond ETFs. Turns out it wasn't even the Fed doing it. That was just people being confident ahead of the Fed doing it. We've seen corporate spreads come back down. Obviously, the market stresses have gone away. A little bit of confidence has come back as the government has passed the PPPs and a lot of the plans that keep corporates alive. But seen is the Fed actually putting rubber to the road and buying the ETFs yet. That's meant to happen today. That'll provide an even bigger support for corporates. So we've seen a lot of corporates coming to the bond market to raise cash if they didn't get PPP loans or if they gave back money. Because they're listed companies, they're going to have to come to the market and get corporate debt finance or equity finance. And we've actually seen a lot of companies with secondaries in the equity markets and raising bond money already. So it's good to know the markets are healthy enough to provide cash to those companies that need a little bit more to get through this.
All right, Phil, thanks for joining me on Trade Talks as always.
You're welcome, Jill.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.